Hello everyone. In this video, we will discuss an important ratio which is related to any stock analysis or investment analysis. That ratio name is PE ratio. PE ratio. So if you are a stock market investor or somebody who is learning stock market or financial analysis and all, you must have heard about this term PE ratio. And most of the time you must be hearing that, oh, if the PE ratio is higher, then the stock is overvalued, then don't invest in that stock. If the PE ratio is lower, then its stock is undervalued, then that's the right time to invest, right? So you must have heard all these things. Now in this video we'll go into the detailed understanding what is PE ratio mean and how do we determine that if PE is higher, then it is an overvalued stock, or if PE is lower, then it's undervalued stock. So we'll get a conceptual understanding, so the next time when you hear the term PE ratio, you should be able to understand what exactly does it mean and how do you do the analysis based on the PE ratio. Yeah, so let's begin. So PE ratio is basically price to earning ratio. Yeah, so let me give you an example, and based on that example we will understand or discuss more. Yeah, so let's take an example of two product. Let's say if you are going into a market, let's say you are going to a market to buy a product. In that market there are multiple brands are available. Let's say there's a brand A and there's a brand B, right? So the market price, the price of the brand A, same product, but the brand A price is 500 and 300, brand B is 300. So now what will you do? From looking at the price you will understand, oh, price of the brand A is higher, so it may be expensive, and this is a cheap one, or let's say less expensive, right? This is less expensive. So first conclusion you will draw, oh, this is expensive, this is a bit cheap. So now would you just directly go and buy that? Oh, this is cheaper, let's buy it. No, because you will try to compare it, right? You will understand what are the quality of these two product, what are the quality or what are the benefit of this. Then you may understand, okay, the product A, it is charging 500 because their quality is good. Let's say it's a 5-star quality product, right? But the B is having 3-star. So you will analyze the quality to understand whether the price, why the price higher, and in this case why the price lower. So you may understand, okay, the quality of the product A is higher, it is a 5-star quality, so that's why its price is higher, and this is the 3-star quality, thus the price is a bit lower. Then you will do further analysis, right? You will just analyze, okay, for this kind of quality is the price is okay, like since they are asking 500, so maybe since the quality is more, that's why they are asking this price, so is this justified? If it is okay, then it's fine. And for this kind of quality, they are asking 300, so for the 3-star quality, is it okay? Or let's say if it is 2-star product, so for the 2-star product, is it okay? So then you will see whether you will compare, right? Based on the quality, whether the price is justified or not. Based on the quality, price is justified or not, right? So you'll do a relative comparison, right? And based on you decide like which is actually expensive. You may come to a conclusion that for this 2-star they're asking 300, which is a bit higher. Then for 5-star it is asking 500, so this is looks more justified. So then you end up buying this one, right? Although the price is higher. So what I mean to say, basically, you just don't take a conclusion or you don't decide based on the price. You consider the quality and other attribute also before you take a final decision, right? To understand which product is actually expensive and which product is actually cheap, right? When you take into the factor both, when you take into consideration price as well as the quantity, then you make a calculation, okay, which is actually expensive and which is not, right? So the reason I'm telling this example is because that is where it will be linked to our price earning ratio. Yeah, so now let's go back to the price earning ratio. Keep this example in mind so that you'll be able to link it. Just a moment. Yeah, so price earning ratio. So now what's the formula? What's the formula? So formula is very simple. Price to earning, it means price divided by earning. Price divided by earning, that's a P ratio formula. Now what do we mean by price? Is the current market price of share. Current market price of share, and earning means EPS. So basically CMP means current market price of one share, and EPS is earning of one share. What earning I am getting on one share. So EPS, again, this the EPS we have already discussed in our previous video. So if you are not aware of it, you can go through my previous videos. I will share the link in the description, so you can go through that. So price of one share, market price of one share, and earning of one share. So let me give you an example to understand. So there is a company A. So company A current market price is 300, and its EPS is 20. So PE ratio is basically 300 divided by 20, that is 15. It's 15. Now what do you understand from it? What do we understand from it? One thing we can quickly understand from it is like EPS is the earning. Okay, EPS is earning. So in order to earn $20, I need to invest 300. In order to earn $20, I need to invest 300. So it means in order to get one earning, in order to earn $1, I need to invest 15. In order to earn $1 from this company, I need to invest 15. So that is one understanding. In order to earn $1, I need to make $15 investment. That's one understanding, right? Now, can you draw any conclusion from this? Can you say whether this company is overvalued or undervalued? No. So just looking at this company's data, you cannot make a conclusion. You need to have some comparative data, right? So let's take an example of company B. So company B has current market price of 200, and their EPS is again 20, for example. So its PE multiple is 200 divided by 20, that is 10. Okay, so since its PE multiple is 10, so it means in order to earn $1 in this company, I need to invest 10 rupees. $10, sorry. So in order to earn $1 here, $15 need to be invested. Here, in order to earn $1, just $10 need to be invested. Okay. So now this has a higher PE multiple and this has a lower PE multiple, right? So if you just compare both the companies, okay, if just compare these two companies, you may feel, okay, this is a bit cheaper, okay, this stock is a bit expensive. When we say expensive, we will say overvalued basically, but I'll not use that term overvalued now. I'll just say this is a bit cheaper and this is a bit expensive. Now again, you cannot just take decision between by comparing two companies. You need to basically check the industry standards also, okay, because if you check the industry standard or industry standard says the PE multiple is 20, then you will understand, oh, both stock are cheaper only. It's just that when you compare these two, this seems a bit more cheaper and this is less cheaper, but both are cheaper when we see the industry, right? That's one thing. So you have the PE multiple, you understand in order to earn $1 how much I need to invest in this company, right? And basically you compare and analyze which is cheaper, which is expensive, and you check against the industry also to do the overall analysis. Okay, I hope till now this is clear. Now how do we know whether it is overvalued or undervalued? Whether it overvalued or undervalued, right? Because some people will just do that analysis saying that, oh, this has a lower P, so this is undervalued, this has a higher P and it is overvalued. That will not be the case always. That will not be the case always, because you need to understand, so this company's current market price is 300, right? So basically for $1 you have to invest 15. It means this is a market price, so it means the people are ready to pay $15, right? In order to earn $1, people are ready to pay $15 because that's what the current market price is, right? So now we need to ask why. Before we draw a conclusion, whether it's overvalued or no, we need to ask why, right? So why people are ready to pay $15 to get just $1 of earning, whereas they can get that same earning here in $10? Because there must be some reason. So we need to see important factors like fundamental. How are the fundamentals of a company? Quick, two things basically: fundamentals and growth factors. So people are ready to pay more. In this case, people are ready to pay $15 to earn just $1 in this company, because the company may be having good growth prospect. Company's earnings are growing at a at a good level, and in future also the growth will increase. If that's the expectancy, okay. One thing is this, and if the company's fundamentals are good, and the growth prospects are very good, that's why the people are paying it. That's why the people are paying premium, right? So considering these factors, sometimes it may be justified. Considering these factors, if both the factors are good, then considering those, it may be justified to pay a bit of premium, okay. But let's take an example. Let's understand. Let's say fundamentals are not good. If the growth factors is also not extraordinary, it is same as the normal industry, right? Fundamentals are not so good, growth factors are also not so extraordinary, right? It's just because the market is in boom, so this current market price is also higher. If those are the cases, right, that fundamentals are okay or not so good, the growth factor is also normal only based on the industry, then in that case we can understand that if there's nothing extraordinary, why the premium is there, right? So in that case we can consider, oh, this is an overvalued stock, right? Or if the fundamentals and current market fundamentals or growth are not so good, it's just because the share market is booming, so that's why the company's share price is also booming. So in that case also you can draw conclusion, yes, it is overvalued. But if the company's fundamentals are growth prospects are very good, then in that case even the higher PE may be justified, right? Similarly in this case, you cannot just simply say that okay, this is a cheaper or undervalued stock, okay. You cannot just say that it's undervalued stock, let's invest in this, okay. Don't ever do that, right? Because you need to understand, if the PE is less, why the PE is less, okay. If the case is like the, again you need to check the fundamentals, okay. How are the company's fundamental, how are the growth prospect. If the fundamentals are good, growth prospects are also good, okay, and still the PE ratio is less, then you can say yes, it is an undervalued stock, okay. If all the things are good, fundamental, growth prospect, is still the PE is less compared to industry or compared to other company, then you can say yeah, it is an undervalued stock, so then you can invest in that, okay. But if the P ratio is less, the market price is less, P ratio will be less because your market price is less basically, right? If it is less because like fundamentals are not so good, the growth prospect is also not good, if those are the cases, that's why it's the P ratio is less, then even though it is undervalued, you should not invest, okay. In that case you will still not say as a undervalued, because its fundamentals or growth are not good, that's why its PE is less. So it's justified basically considering the financial position of a company, right? So in that case, even though PE is low, you should not invest. So basically what I'm trying to say is like, you check the market price of a stock like a product when you buy, right? You check the market price, you check the quality. So here you understand the price, you understand the PE multiple, which is higher, which is lower, but you need to analyze the quality, like why the price is higher, why here the company people are ready to pay more premium to earn $1. So you need to understand the reason. If the fundamentals are good, growth prospects are good, then it is justified to pay here even though it is less, okay. But if the fundamental growth prospects are not good, that is not justified to pay, right? So those things also need to consider before you decide and invest. So just because the PE is lower and you invest, that's not a good practice. You need to understand in detail, right? And this growth factor is an important factor, okay. Growth factor is important factor. So there is another actually formula for which is called PEG, price earning growth, okay. Because in this PE multiplier, okay, in this PE multiplier we are just considering price and earning growth, we are assuming, okay, in the future, or we based on the industry standard, the growth would be more, right? So that's why we are taking a call, okay, this price may be justified or this is justified, right? But there's another formula, price earning to growth, which actually takes the growth into account, and that helps us in taking the further decision whether that price is justified or not. Okay, so yeah, so I'll just quickly say, price to earning is basically current market price divided by earning per share. Okay, it tells you it in order to earn $1 in a company, how much investment you need to make. You can compare it with the industry and with the peers to understand like where you need to make the higher investment, where you need to make lower investment to earn the same dollar. But you can understand, okay, here you are investing more to earn $1, so it is an overvalued stock. But you need to understand the background also, like why it is overvalued or why it is higher than the peers. Is that the company fundamentally growth factors are good, that's why market is ready to pay premium? If yes, then it may still be justified. But if the other factors are not so good, still the price is higher, then you can definitely say it's an overvalued stock, because it may be the price may be just higher due to the market is in bull run, right? Nothing good in fundamentals or nothing so great in the growth, then you can say it's a overvalued stock. Similarly for undervalued, p less doesn't mean that you have to invest. You need to it's undervalued and you have to invest. You need to understand, if the fundamentals are good, growth prospects are good, still the P is less, then it's a good bet to invest in. Otherwise you need to see if the fundamental not so good, growth are not so good, and then the P is less, then still you should not invest it, because even if you invest it, price may tend to go down, right? Because the fundamentally the company is not good. So all these things you need to consider. So in the P ratio there are multiple things also, like there's a PEG ratio, what I talked about. There's an important ratio we need to discuss, so we'll discuss in the future video. We'll also discuss about the forward and the trailing PE. So like basically you tune in for the new videos also. And if you like this video, so please like you can like the video and subscribe the video. And if you want to put any comments, please, if you like my effort to explain these things to you, please just mention some comments. It will be a good motivating factor for me as well. And I'll see you in the next video. Thank you.